Well, hyperinflation is not inevitable, and I would still think that it's more likely that we won't end with hyperinflation. But I think that there's going to be very high inflation. There's no question about that. So the dollar won't lose 100% of its value, but it could lose 50% of its value very easily. It could lose 70 or 80%, or maybe even 90% of its value without going to zero. The dollar is just going to keep falling. And so the gold price has to keep.
The US dollar hovered below a three-month high to the euro on Thursday as attention turned to the European Central Bank's rate-setting meeting later in the day after US inflation data failed to alter views for a Federal Reserve pause next week. Gold prices firmed on Thursday as the dollar and Treasury yields weakened after the US inflation data cemented the case for a Federal Reserve rate pause next week. However, bullion was not far from the three-week lows seen in the previous session. According to Peter Schiff, the dollar's decline is expected to continue, leading to an increase in the price of gold. He argues that gold prices may rise substantially, potentially approaching levels that seem infinity when compared to currencies with severe devaluation, such as the Zimbabwean dollar. While highlighting the historical perspective, he also notes that the value of the US dollar significantly erodes over the years. When the Federal Reserve was established, it took $20 to buy an ounce of gold, whereas now it takes nearly $2,000. The rise of emerging market economies is one of the primary reasons why the position of the US dollar as a global currency is eroding. Countries such as China, India, Brazil, and Russia have experienced rapid economic growth in recent years, and their share of global GDP has increased significantly. As a result, these countries have become more significant players in international trade and finance, and they are increasingly challenging the dominance of the US dollar. To prevent the dollar from reaching zero, Peter suggests that the government would eventually need to take corrective actions, such as allowing companies and banks to fail, letting investors and creditors suffer losses, and cutting benefits like Social Security, Medicare, and government pensions. Such actions might cause discomfort, but they are preferable to the alternative of hyperinflation. Despite the challenges, it is a necessary course of action to preserve the value of the dollar. We will now bring you clips from Peter Schiff's interview with Rafi Faber. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The price of gold, probably approached infinity in Zimbabwe. I don't know how many Zimbabwe dollars. You needed trillions of Zimbabwe dollars to buy one US dollar. So you needed a lot more to buy an ounce of gold. But yes, if you look at where the price of gold was when the Federal Reserve came into existence, you needed $20, 20 Federal Reserve notes to buy an ounce of gold. Now you need almost 2,000. That's 1,900 and change, but let's just call it 2,000. That means that the dollar or the Federal Reserve note has lost 95% of its purchasing power. No, 99% of its purchasing power, because you need 100 times as many dollars to buy an ounce of gold today as you did when they established the Federal Reserve. So that equates to a 99% loss of value. It's not that the price of gold has gone up. No, the price of gold is really the same as it was 100 and some odd years ago. It's just that the dollar buys that much less gold. It's the dollar that's lost value. Gold hasn't gained it. Gold has just retained it. But in order to prevent the dollar from going to zero, eventually the government is going to have to do the right thing. Now, the longer it waits to do the right thing, the closer to zero we're going to come before they finally do the right thing. But doing the right thing is going to involve a lot of short-term pain, although we're probably going to have a lot of short-term pain before they even have a catalyst to do the right thing. But they're going to have to let people lose money. They're going to have to let companies fail, banks fail, depositors lose money. They're going to have to be honest and cut benefits like Social Security and Medicare and government pensions and cut national defense. They're going to have to act fiscally responsibly, something that they've never done. And the reason they don't want to do it is because the voters don't like it. Well, they're not going to like massive inflation either. But at some point, if we want to prevent, hyperinflation, which would be the worst possible outcome, then politicians and the Fed, they're going to have to do the opposite of what they've been doing. And that is, act responsibly. So interest rates need to be much higher than they are now. And that means a lot of debts are going to go into default. And a lot of people are going to lose money because they can't get paid, whether they're private creditors or whether they're creditors of the government, whether they loaned the government money and bought a Treasury bond, or they've just been promised a benefit like Social Security, Medicare. Everybody is going to have to give something up. There's going to have to be a restructuring of all these liabilities because there's no way that the government can pay them. The only way they can pay them is with massive inflation, which means you don't get paid anyway. You get paid money that doesn't have much value. So I think people will be better off getting 50 cents on the dollar, but the dollar still has value, than getting 100 cents on the dollar where the dollar has no value.
Peter discusses the historical devaluation of the U.S. dollar in relation to the price of gold. He mentions that President Franklin D. Roosevelt initiated the first devaluation in 1933 when he raised the gold price from $20 to $35 an ounce. This price change incentivized gold miners globally to expand production and foreigners to export their gold to the United States while simultaneously devaluing the U.S. dollar by increasing inflation. The increase in gold reserves due to the price change resulted in a significant accumulation of gold in the Federal Reserve and U.S. Treasury, much of which was stored in the United States Bullion Depository at Fort Knox and other locations. The increase in gold reserves increased the money supply, lowering accurate interest rates and increasing investment in durable goods. Peter points out that the official price of gold has not been adjusted since then, remaining artificially low at around $42 per ounce. However, he believes that the market's actual valuation of gold is much higher, currently around $1,900 per ounce, and the discrepancy reflects a reluctance by the government to officially acknowledge the devaluation of the dollar. Let's get back to the interview.
Roosevelt devalued it the first time in 1933. So it was $20 an ounce. And then Roosevelt devalued the dollar and raised the gold price to $35 an ounce. And it stayed at $35 an ounce until Nixon. And that's when he devalued it to 42, whatever, and change. And then we just abandoned the gold standard. And so they've never devalued since. I mean, if they wanted to be honest, they would say that it's 1900 because that's where it is now, right? 1940 or something. But we're pretending that the gold is only $42, even though the market shows that it's a lot higher than that, because they don't want to have to officially devalue the dollar that much. They just ignore it to have any real world consequences, because the Fed doesn't have any gold on its balance sheet. The only gold is in Fort Knox, and that belongs to the U.S. Treasury. And I mean, it doesn't really matter what they want to claim it's worth. We don't even know how much gold is still there. But I don't think it's going to matter to anybody at this point, if we, just officially devalue the dollar to the current market price. Mm-hmm. But, even if we do that, it's not going to last because the dollar is going to keep depreciating because we keep printing them. Our deficits are over $2 trillion a year right now. Our budget deficits, our trade deficits are over $1 trillion a year. Mm-hmm. So we have these trend deficits that are growing really exponentially now. So, the dollar is just going to keep falling. And so the gold price has to keep rising. It's not going to go over well because the markets are used to the Fed coming to the rescue whenever there's a problem. And so in order to stop this, the Fed is going to have to tell everybody who's been expecting a rescue, right? It's like the cavalry ain't coming. You got to deal with these Indians because we're not coming. And yeah, that's something that nobody is prepared for because, they rescued everybody after 2008. They rescued everybody with COVID. They rescued everybody from this spat of bank failures earlier this year with Silicon Valley Bank and Signature Bank. And so they came in, printed a bunch of money, backstopped all the losses. That's what investors expect. That's part of the moral hazard because investors take a lot more risk because they believe the government's got their back. They don't think that they can lose because they think if they are losing, the government's going to come in and turn it all around. So they are very aggressive in what they're doing. And they're in for a rude awakening when they get fronted with reality. We're already seeing a breakdown in law and order now. I mean, look what's happening to the cities and the crime wave that's been going on with shoplifting and all the things that are happening now. And things aren't even that bad. I mean, they're bad, but they're not the way they're going to be. So when you're talking about hyperinflation or just very high double-digit inflation, where the government ends up instituting price controls, which they very well may do. In fact, I think that's pretty likely. And once they institute price controls, that means there's going to be shortages of everything. And that means they're going to have to ration things. People are going to be waiting in long lines to buy, basic necessities. There may be rolling power blackouts as we have to ration power and things like that. In that kind of environment, I think crime could just explode, in this country, given where we are now. So yeah, I mean, it is a concern of mine, and everybody should be concerned about how much crime there's going to be. And you better be prepared to defend yourself. Don't rely on the police, because they're going to be too busy protecting their families, to try to protect yours.
The recent decline in the dollar's value is anticipated to continue in 2023, which could result in higher gold prices. According to the analysts, when the Federal Reserve closes its tightening cycle and U.S. economic prospects worsen, we expect the dollar will enter a period of cyclical depreciation and decline versus most foreign currencies for next year. What are your thoughts on the interview? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.